Hey, welcome to the What the Wealthy Do podcast, where we break down the tips, tricks, strategies, and cheat codes that the ultra wealthy use as they're building their wealth and show you how you can use those same strategies as you're on your wealth building journey. Hi, my name is Stephanie Dorsey. I am the host of your podcast, and today we're going to continue our tax mitigation strategy subject, which, as you remember, falls under the move money pillar under the 4M framework. I know I'm giving y'all a lot, but just in case you forget, the 4M framework, money mindset, is at the top of the house. So first pillar is how you make money. The second pillar is how you manage your money. And the third pillar is how you move that money. And so today we're going to continue our conversation about moving money and moving money in a way that mitigates your tax liability. And so before we jump in, I have to remind you all that today, this episode, as well as the entire podcast, is not intended to give you financial advice. However, we are intended to give you financial education. Today, we're going to be talking about a wealth tool that the rich use all the time. It is one of those things that sound very, very, very boring, but it can save you a lot of money, and especially if you use it right. And that is bonus depreciation. You're like, girl, what? Yes, bonus depreciation, as well as we're going to talk a little bit about the use of a cost segregation study as well. So we're going to talk about it. It makes sense. Like, bear with me. Just come on with me now. All right. So let's start at the top. Depreciation. Depreciation means that an item loses value over time, right? So a car, like when you drive it off the lot, it drops in value. And then the more you drive it and the more miles you get and all of that, it starts to lose its value. It depreciates in value. And so bonus depreciation is a tax strategy where business owners or investors, they get to write off the entire cost of their asset in the year that they bought it. Okay. You're like, wait, what? Well, typically, an accounting principle, you will write off, say, for instance, you bought a piece of machinery. Let's just say that, like a big old, like some type of tractor. How about that? Let's say you bought a tractor. The tractor costs $100,000. Typically, the life of a tractor is 10 years. I'm just throwing these numbers out there. It very well might be longer. But let's just say it depreciates over 10 years, $100,000. You write off $10,000 every year. And so on your taxes, you get to write down this depreciation expense of $10,000 a year. Well, now you get to write it off $100,000. You bought the tractor in 2025, you write off $100,000 in 2025. I know, right? And so the reason why this matters, I know you probably like, girl, ain't nobody buying no tractor or forklift or whatever this craziness you're talking about. That is true. However, doctors, you might buy some exam room equipment, right? Spa owners might buy a body contouring machine. A real estate investor might have to renovate their property. And we'll talk about that. There are some limitations there. Even coaches or consultants or whatever you have, like you have your side business. I have a really good friend who is a DJ, and he buys DJ equipment, including new computers or anything that supports his business. Like those type of things you get to write off. So I do want to be clear. This only applies to business owners or investors. It does not apply to regular W-2 people. This has to be a part of your side hustle or your side business. But we are all investors, so don't get freaked out. Like, we there. Stay with me. Hang with me now. Why is this important? Or what's different? So before 2017, before your boy's big, beautiful tax bill of 2017, you could not do this, right? But we know that Donald Trump is for the businessmen of the world. And so he created this ability to do bonus depreciation, not just regular depreciation. You can do bonus, which is writing off 100% of the thing you bought in the year you bought it. Well, it was phasing out, but fortunately, I'm gonna say it. Fortunately, I'm saying it ironically, but I'm also saying it. Trump's bill in 2025 brought it back, and now it is permanent, and you can write off 100% of the thing you bought in the year you bought it. All right, so This means that, like I said, you get to deduct 100% of the cost of qualifying assets. You do not have to deduct over 5, 7, 10, 15 years anymore. And it does apply to used property. So if you buy something that's used, whatever, you get to write that off. And say, for instance, because you're using all of these tax mitigation strategies, you have already written down all the losses that you wanted and mitigated, or you made $100,000 and you have $150,000 a write-off, you can carry over the $50,000 to the following year. You do not have to use all of your write-offs in the same year. So that's pretty cool, right? All right, so let me give you a real life example for my investors, specifically my real estate investors. So say you bought a property for 50 grand and you want to renovate it for $100,000. Unfortunately, you cannot write off the entire $100,000 because land does not qualify for bonus depreciation. However, if in your renovations you include things that do depreciate, like you have to buy new appliances or you have to replace all the flooring and things like that, what you can do is get a cost segregation study. A cost segregation study looks at each element of the property and tells you which element qualifies for the bonus depreciation and which don't. And say you get the cost segregation study, it tells you, okay, $40,000 of the $100,000 that you plan to use for renovation qualifies. And so again, that's $40,000 that you get to write off on year one. And that equates to, say, like if you have a 30% marginal tax rate, that equates to $12,000 of money in your pocket, right? In your pocket that you wouldn't have had before. So this could very well apply to you. Again, and unfortunately, it doesn't apply to you as a W-2 earner, but it ain't hard to go right now by yourself, create an LLC. You do not got to pay nobody. You ask ChatGPT how to do it. You go to your state's website or you come to Delaware, but just go to ChatGPT. There are like 3 steps. Literally 3 steps. I'm not going to waste our 15 minutes talking about it, but there are 3 steps to create your own LLC, and that's voila. You are an investor with an LLC ready to do this, right? So this is not beyond you. It's not. But I do want to remind you, I'm not a CPA, nor am I a tax strategist. However, those people do exist. And when you're talking about saving $12,000, $20,000, $40,000 a year, it's worth to pay them $2,000 or $3,000 or $4,000 to help you do that. All right. Okay, that's a lot. It's not a lot. Actually, this one was the fast one. I thought it would take longer, but that's okay. I just want to remind you, today we talked about the big, beautiful tax bill. We talked about how the use of bonus depreciation and cost segregation studies, if you're a real estate investor, can be used to help you mitigate your tax bill. The tax code is full of rewards and ways for you to mitigate your tax bill. But remember, the tax code benefits businesses and investors. Unfortunately, it does not care about us W-2 earners, but that's all right, because now that we know how to play the game, we can play it. If you found that this episode was beneficial to you, please like, subscribe, share it with a friend. Also, give us a 5-star review if you find it in your hearts to do so. And I'll see you next week, where we talk about the last and final tax mitigation strategies of this series. I am certain that there will be more to come. All right, bye.